All right. Hello, everyone. We're just about to get started here. I see all the participants are joining in now. So just another few seconds here and we'll get going. Okay. So it looks like we have most people now. So thank you so much for joining today's webinar. Today, we're going to talk about improving your technical analysis in MarketSurge by using custom moving averages. And my name is Jacob. I'm one of the premium product coaches here, and I am, of course, the host of today's webinar. And then, as always, our disclaimer. So this webinar is for educational purposes only. So none of this is any sort of recommendation to buy or sell any specific security. All right, so let's go over the agenda of what we're going to talk about today. So I'm going to start off by talking about what a moving average is, just in case you're still kind of getting comfortable with exactly what these are and what they're telling us. I'm going to talk about why they matter, how they really help us out in buying and selling stocks. I'll discuss some of the default moving averages and some of the custom moving averages that are very frequently added into MarketSurge, and how we use each of these, kind of what are some of the advantages and disadvantages of each of them. I'll give you a quick tutorial on how to actually set up custom moving averages in MarketSurge. And then I'll give you a few examples of using moving averages and really show you kind of some key lessons that we can take away from using different moving averages in MarketSurge. And then finally, we'll finish it off by talking about how moving averages can help us out with our risk management and just avoiding any sort of false signals in price action in MarketSurge. Okay, so what is a moving average? Now, by definition, a moving average is a technical indicator that investors use to determine the trend of securities. Now, a moving average is calculated by adding up all the data points during a specific time frame, say like a 50-day period for the 50-day moving average, and then dividing the sum of all of those days by the number of time periods. Now, a lot of times you'll see that a key moving average is used as an area of support or resistance for investors. And you'll notice that stocks will frequently stay above a key moving average when they're in demand, or really have those moving averages be a sign of resistance as a stock really struggles to get above when a stock is really out of demand or really selling off. Now, the main way that we use moving averages is to really spot these areas of support and resistance. But these moving averages are really going to help us out with the trend in the stock as well. So we want to spot abnormal behavior as early as possible so we can get out of a stock when it's in trouble and get into a stock when the trend is really going well. So we're going to use moving averages both to add to positions when maybe a stock pulls back, or hold on to it when a stock pulls back. And then, of course, the moving averages are also one of the key sell signals that we use. All right, so let's talk about why these moving averages really matter. And here's a overlay of really three of the most common ones. Right, so one that is frequently added into MarketSurge is a 21-day moving average. And you'll notice it says EMA there. If you're not familiar what that means exponential moving average. And so an exponential moving average is going to react more quickly than a simple moving average. It's going to put more weight on the more recent price action. Now, because it's a shorter time frame as well, a 21-day versus a 50-day, it's going to be more reactive, right? And so this is a moving average more frequently used by somebody who maybe like a swing trader, or somebody who wants to be much more active, maybe somebody who's just being more cautious or a little worried about the market. They'll keep an eye on the 21-day or other shorter term moving averages that we'll talk about. Now, for the 50-day, this is very frequently used. I know for myself, if I could probably only have one moving average, I wouldn't want to. But if I could only have one, I'd probably go with the 50-day. I'd be interested in what some of the other thoughts are out there on exactly what is everyone's most important moving average. But you'll frequently see that leading stocks pull back to the 50-day with some regularity. And if it's a really good stock, something that's really in favor and trend, the institutions really like that particular security, you're going to see those investors come in, buy up that stock, and it'll really kind of bounce off the moving average. And then finally, there's the 200-day. And the 200-day moving average is really going to kind of help us identify those longer term trends and the overall strength, like across like stocks. Like you can kind of get an idea of the entire market, but then in particular the trend in that stock. It's a really important thing with the 200-day. All right. And then talking about some of the default and custom ones, as I mentioned a moment ago, the 50-day and the 200-day are both the default moving averages. The 50-day being the more responsive one because it's a shorter time period, and the 200-day being a longer time period and less reactive, right? So that 50-day is more responsive, frequently used by institutions. Now, if there is a lot of volatility, kind of the shorter the time frame on a moving average, like kind of the more likely it is to really impact you, right? Because if something has a shorter term moving average, a lot of volatility can kind of chop it above or below the moving average and be a little bit more difficult to kind of really get a good idea of the trend and kind of whether or not it's something that's really selling off, like if I should leave, sell my position if it drops below a moving average. Shorter term moving averages are going to be more subject to that. Whereas a 200-day is going to kind of filter out some of that noise, but it's going to be slower to react, right? A lot of people would say like the 200-day is too late. I find it very useful, but if by the time it gets down to the 200-day, the stock may have already sold off quite a bit by that point. But it does give us that much smoother look and helping us really understand the long-term trend of a stock. So here is the 50-day and the 200-day on the chart, if you haven't seen them, right? So the 50-day is that red line. It's automatically going to be there. Again, it's a simple moving average, so it's just averaging out the last 50 trading days, and that's the red line. The black line is the 200-day moving average. That is also a simple moving average by default, and it will always be there on the chart for you in MarketSurge automatically. Now, one note, and this is a subtle point, but it can come into account, particularly when we're really analyzing stocks. Is when we go over to the weekly chart, these are put into a weekly basis. So uh, the 50-day becomes the 10-week, right? Because there's 50 trading days in 10 weeks, and then the 200-day becomes the 40-week. Okay. And there can be very subtle differences in kind of where you see them at. It's never anything dramatic or huge. I'd say overall, maybe that weekly one moves a little bit faster, but overall, they're the same idea. But when you're really, my point is in mentioning this is when you're really drilling down on a stock, you're either in something that's like a full position for you and you're trying to decide whether to hold or sell, or if you're thinking about buying a stock, even though we kind of start out our research on the weekly chart, you'll want to look at both, right? It'll really help you get a good idea of the technical behavior, where the stock is relative to its moving averages, and can really help you out in that regard. So one subtle but useful point that I wanted to bring up there. Okay, now as for the custom moving averages, how exactly can they help us out? Now, one way is we want to be in alignment with our overall trading style, right? So, say a swing trader might prefer those shorter term moving averages, right? That you see that very frequently. Something like a 10-day moving average. I've even seen folks will talk about it like an 8-day, right? Something even shorter, using an exponential moving average because it's going to be even more reactive. And whereas somebody who's like a long-term hold, or somebody who wants to just kind of get into a great stock and just kind of be largely in for the ride and have kind of looser sell signals, they're going to prefer those longer-term moving averages, right? Maybe starting at a 50-day, but kind of working its way all the way up to those 200 days. Now, a shorter term moving average is also going to just reduce that lag, right? We talked about how the 200-day can actually be like a pretty late sell signal in some ways. The shorter term moving average or any sort of custom moving average can really just help us keep in tune with a stock's behavior, right? So something like a very like active in demand tech stock, you'll see it maybe pull back to the 21-day on its run higher, and maybe not even get down to the 50-day in like a very strong part of its run. But again, for those who are kind of long-term traders, maybe somebody who likes a little bit more kind of a steady stock, some of those longer-term moving averages are going to be more frequently used. So adding in those shorter-term moving averages, you'll kind of get a little bit more information from those during those shorter term moving averages will help us out quite a bit on those really high tech growth stocks. And then the custom moving averages, those shorter terms, can really help us out with our setups. And because if you don't have them on there, you might not even, you won't even see those pullbacks to say a 21-day or a 10-day. And so adding them in, particularly on the daily chart, I'll show you that, but adding those in can really help us kind of spot those kind of early signs of weakness and strength for our stock. Okay, so here are some of the frequently added in custom moving averages. I would say among the options here, certainly that 10-day is the most common to add in, right? So that's going to be even more responsive than the 21-day, which was the fastest one that we had mentioned previously. So certainly for like a swing trader, shorter term trader, maybe somebody who's kind of entered into a stock out of a late stage base, something like that, and they really want to just be very careful in managing their position and not taking on too much risk, they might add on something like a 10-day or a 21-day. Oh, it looks like my screen cut out there for a second. Apologies there. Okay. All right. I'm back up. So sorry. Make sure, hopefully you can all still see my screen here. Yeah, if there's any trouble seeing my screen, please let me know. My screen blacked out there for a moment. Okay, yeah. So back to the 10-day, a very common short-term moving average, right? So for those of you who are interested in that kind of short-term trading, who really want to see those very early buy and sell signals for whatever reason, that 10-day is a very popular one to go with. Now, the 8-day, even more reactive. I don't see this added quite as much, but for those of you who are very reactive, those swing traders, the 8-day and even an EMA will be very quick. And then an interesting one, I don't see this one added too often, and in all candor, all transparency, I've never used this one, but a 65-day. And I guess where that one comes from is that it represents a quarter of a year, right? So kind of an interesting idea. Yeah, again, not something that I've implemented, but I have talked to a few people who have done so. And so really adding in any of these can really just help us see those exit signals when we are kind of trying to decide, right? Like selling is hard, and these moving averages can really help us out with that. Okay. All right. So let's go ahead and actually pull up the chart here. I want to demonstrate a few things here. So we have that. All right. So now I have a chart up, and I want to show you how to add in these moving averages. And in this instance, I'm going to head over to the daily chart, and I'll explain why. So to add in the moving averages, what we're going to do is we're going to go up to the wrench here at the top, and then this drop down box shows up, and there's a selection here kind of towards the bottom that says moving averages. Okay, so I'm going to click on moving averages there. And this is where I can pick my moving averages. And I remember early on, it kind of seemed a little bit confusing at first, like exactly how these are all set up. Of course, it becomes very intuitive once you know, but I do want to show you how to add each of them for each of our different charts. So I'm going to kind of start at the beginning here. And right now, you'll notice it just says none, right? Because I have no custom moving averages. But notice I have the black line and the red line on my chart right now because those are always there. The 50-day and 200-day are always there. Now, if I want to add in a moving average, I can head over here, and this is going to be a green line, right? It says number one, it's in a green box. Let's do the 10-day there, right? And then for the kind of that pinkish, purplish line, I can add in a second one. Let's do the 21-day, right? These are some of the most popular ones. And I can decide whether or not I want them to be exponential or simple, right? So again, those exponential moving averages are going to be more reactive. there isn't a right or wrong answer, right? I've talked to a lot of people who've had a lot of success using either the simple or exponential, kind of more just, we all have our own wrinkles in our investing style, right? Even though we all kind of fall under, believe in the IBD methodology and all kind of come from the same philosophy there. There are, of course, kind of many different approaches here that can all work. But we'll just check exponential here. Now, something that's very helpful. We have this little checkbox here. And what this is going to do is it's automatically going to do the math for us for the weekly chart, right? It kind of help us avoid any sort of mistakes in getting these moving averages on here. So a 10-day moving average is equal to a 2-week, right? Because there's 5 trading days in 1 week. So a 10-day equals 2 weeks. And then it's going to get us as close as possible here as well. So the closest weekly moving average to a 21-day is a 4-week. So if I check this box, it's just automatically going to add those moving averages in. All right. Not as frequent to add monthly moving averages. I have not kind of found a moving average that really helps me out so much on the monthly chart. I'm really looking at those longer term trends personally when I'm on a monthly chart. So usually on particularly for these shorter term moving averages, the daily chart, but the weekly chart can be helpful as well. So let's talk about some of the kind of advantages and disadvantages there. So here we have our 10-day, which is the green line, and that pink line is our 21-day, right? Those are the two that we just added on here, right? Now I can see them here on the daily chart, and we kind of see a couple of bounces already, right? Like right off of those, really helping us out. We kind of get back above the moving averages there. Because we kind of have this right side of this base building out, if it's something that I was really kind of considering, seeing the strength of the right side there, these are all kind of really positive indications, right? We kind of see it just bouncing, just kind of riding right along, getting above it. When it pulls back to it, just bouncing right off of it, right? And so that's what we're using these moving averages for. These are signs of institutional behavior, right? They're the ones moving these stocks around. When they like a stock, they're gonna pick up some additional shares or open up a position when it gets to that moving average. All right. Now, the reason I mentioned daily is because if I head over here to the weekly, it can be hard to see those, right? Like I showed you, I added them in, but it's really hard to see. Like right there, there's the 21-day. So if we are using these custom moving averages and we pick something that's pretty short term, right? Like a 10-day or a 21-day exponential, those are very reactive, and the price bars can kind of cover it up a little bit, right? If we add in something longer term, you're going to see those no problem. But on the daily chart is really going to help us out for those shorter term moving averages. Okay. And let's look at a couple examples. Say I'll use like the 50-day, just while I have the charts open here, just kind of to be able to demonstrate a couple of things. Let's head over. I think it was Google there. And let's look at the weekly chart. Okay. So this was Google as of a few years ago. And the reason I mention this, because I remember really seeing it, right? So this was March of 2020, right? We had a huge sell-off in the market there. And, stock kind of broke out. It's just the kind of something of a breakout there, not particularly strong. But then we had another early stage base here. And you'll notice like this stock, when it pulled back, built that base, it pulled back right to the 200-day line, right? So if, one was kind of maybe already in this, they're kind of seeing not particularly strong at this point, but we did get, the point is it pulled back to the 200-day and found support. And then kind of all along the way, right? We had another base here, kind of just dipped barely below the 50-day, but kind of closed all along the way, right at that 50-day. And then all along this move higher, you kind of just see over and over again these pullbacks to the 50-day, but it keeps bouncing, right? A lot of demand here, a lot of very strong move higher. Of course, we all remember what the market was like. It was very strong. When these big institutional investors had the opportunity to get into a strong stock that was in favor at the time, they would just add in right at the 50-day. And then you'll notice this change in behavior, right? It goes from this uptrend that keeps on finding support to breaking below that 50-day, closing below it for several days. And then again, right, this kind of selling behavior. And this is when we see those sell signals, right? So definitely drops below the 50-day, does not find support there, even falls below the 200-day and kind of makes an attempt. You frequently see this. The stock kind of makes an attempt, but just cannot do it. We have the 50-day crossing below the 200 days there as well, right? So we're getting a lot of a lot of our alarm bells for selling are going on here. And then we just see the stock just kind of continually fall below the 50-day. Again, it tries, falls below, tries, falls below, right? So very common behavior. So these moving averages extremely helpful, right, on both ends. So when a stock is doing really well, we find that support, and when a stock is really selling off, doing very poorly, we just find that consistent resistance. And you'll see this just all the time. I think Shopify was a similar way at that time, right? So we had, kind of the stock really just kind of holding around here. Kind of, it always seemed to kind of close right near it. Here it found support at that 200-day, again found support at that 200-day, and then just a sell off, right? Drops below the 50-day, drops below the 200-day, and just cannot find its way above, right? And I mean, this was a dramatic sell off. What, this one 167 down to about 27, just huge sell off, right? We are not going to be in this. So when we see things like this, stock selling off very strongly below its key moving averages, right? 50-day dropping below 200-day, just so many of our sell signals are being triggered there, right? We really sell on the technicals. The technicals help us a lot on buying and holding and all of that, but really when we're thinking about selling a stock, these technical actions are really, really huge for us. Okay. All right, so let's head back over to the slides here. All right, so let's talk about some other examples of the custom moving averages. So a custom moving average is going to help us find strength in those shallow pullbacks, right? I showed you some of those pullbacks to the 50-day there. We're going to see the same kind of thing for the 10-day and 21-day, right? You're going to see those types of pullbacks to that. And so if we take a look here, these are the kinds of bounces, right? So we see here stock found support there. In this instance, the 21-day is the green line. So we have the 21-day, right, pulls back to it. And notice we have high volume right on that bounce, right? Bounces right off of it, high volume. Just like we're looking for a breakout, right? Like that high volume as the stock moves higher, bounces off of a moving average. That's a very positive signal for us. We see that again, right? Stock starts to trade sideways there for a little bit, bounce right off of it, high volume. And then again here, bounce off of it, high volume. And then finally, we see the stock really break below the 21-day. And that was when it really started to kind of sell off there, right? We had kind of higher volume, slightly above average for a couple of days there, and breaking below that 21-day finally. But all along this way, all along this move higher, we saw that it was able to stay above that 21-day. And anytime it bounced off of it, we had some nice volume coming in. Another example here, right? Even a longer term example, right? So again, we see that support, right? Stock just constantly just bouncing right off that 21-day, right? Like here, it's almost like you can almost there, you can almost just see it. Like it almost just feels like all these institutional investors are out there. Hey, if it gets to the 21-day, I'm gonna pick up a couple shares, right? And again, huge move, high volume, and always just finding support there until we had that real change in behavior where the stock just started moving sideways, right? Broke below, right? Not necessarily any sort of terrible behavior at this time. A lot of investors would have kind of held through this, or maybe some would have sold. But because it built out this base, right? So it's very common for it to kind of break below these moving averages and then work its way above on the right side of a moving average. But really, a very clear sign of a change in behavior here, right? Because here it was all just staying above the 21-day, starts working its way sideways for some time. All right, now we also get momentum clues with custom moving averages, right? So using both fast and slow moving average combinations can really help us spot these changes in momentum. And then I mentioned this earlier, like a crossover among moving averages. And I'll tell you, there's a lot of different opinions on this. I know some people really swear by, say, like the 50-day crossing the 200-day or 21-day crossing a 50-day to the upside, and that being a very strong sign of strength. And then in the reverse, say like the 50-day crossing below the 200-day or the 21-day crossing below the 50-day as a sign of weakness. Um, some people really call that a lagging indicator, right? And would almost, if we only do that, we're going to be behind a lot of moves. So kind of again, there's different wrinkles, different approaches, but I do want to make you aware of that, because if it's something that you're not doing, it might be something worth looking at. Go back and investigate some previous charts and really see if those moving averages and those crosses of moving averages, both to the upside and the downside, can really help you out. And then finally, when as always, when a stock is breaking out, we're buying it or we're deciding to hold on to it. We want to see the relative strength line trending upwards, right? Because what we're doing here with all of our analysis is we're putting a lot of different things together, right? We're really trying to stack the bet in the most favorable way for us. So we want to see a lot of different boxes being checked, right? We have other webinars that talk about the fundamentals and how that helps us in buying. But then from a technical perspective, of course, these moving averages are very, very important. But we still have other tools here to help us, right? I talked about the volume. We like to see that relative strength line moving higher as another indicator of strength. And so we see here, right, like early on in the stock's move, right, we had that 21-day, right? It was kind of just going sideways here in the base. We had the 21-day cross the 50-day to the upside. And this stock was just kind of working its way sideways for a little while, right? It kind of come off this bit of a pullback, worked its way sideways for some time, and then really during this whole run, the 21-day did not go below the 50-day again. And this was about a double, right? That showed up. So you'll see this, right? I mean, it's kind of just baked into the reality of a strong move higher. Is that those shorter term moving averages are going to be more reactive than the longer term moving averages. And so you'll see this type of behavior in there. And so if that's something that you really find compelling, it can be worth really paying attention to that. It's kind of one checkbox on your checklist when deciding whether or not to buy a stock. Now, we get a holistic view of technical strength from these moving averages, right? And as one part of our kind of overall analysis. So we do want to see that prices respect the key moving average, right? So once you see that kind of trend, right? Like when we looked at Google earlier, we just constantly saw it bounce off the 50-day. And so we want to see it keep doing that. And until it doesn't, is when we kind of have a potential sell signal coming in for us. Like, hey, during the stock's whole run, it's just been bouncing off the 50-day, and then all of a sudden it doesn't, right? It breaks decisively below that moving average. We also like to use trend lines, right? That's something that can be very helpful in a lot of ways, right? Kind of the up and to the right moves, like we saw on that Google chart. It almost serves as a trend line in some way, but trend lines, it's a very similar idea, right? That a stock just kind of continues along its behavior and a certain trend, and then once it violates that, we're getting a signal. And then, as I showed you in the example earlier, those volume spikes, right? So as a stock breaks above or finds support at a moving average and bounces off of it, a volume spike to the upside is a good thing. Now, if a stock breaks below a moving average and there's high volume, that's a negative sign. That's one of our key sell signals that we look for, right? So putting all of these things together really gives us a very good overall look at the technical behavior of a stock. All right, and finally, risk management and avoiding false signals. Just kind of some things to keep in mind, right? When really using these bit of maybe words of caution, just things to think about is, this is kind of true with anything. We don't want to make our lives too complicated, right? These 50-day, these 200-day, 21-day, 10-day, if we want to add those are quite strong, right? So we don't want to necessarily do something too advanced unless we have kind of a lot of evidence to go with it, right? So if we say like set a 17-day, right? Maybe it's a good moving average, but you really want to make sure that you've done your homework. Look at a number of charts and see that that's really something that's going to help you, right? Not that just we only saw it happen for one stock and then have all of these moving averages that maybe won't help us out too much, right? And so those 21-day, the 10-day, the 50-day, the 200-day, those are all kind of well studied, right, and have been used with a lot of success. So it might be worthwhile just kind of sticking with those unless you've really done your homework and found something else that's particularly useful. Now, we don't only use moving averages, right? I talked about some of the other things that we'll use, right? That RS line, Those trend lines are going to be extremely helpful to us. We always want to keep an eye on the market when we're buying. We want to look at the fundamentals, right? So this is not a moving averages only type of thing, even though these moving averages are extremely important. And then finally, not every dip below a moving average is necessarily a sell, right? We saw a few times as these stocks move sideways, right? They go on a nice run, we get a change in behavior, but it kind of just bases, right? If we still want to stay in that stock, just because it drops below a 10-day or 21-day, or even a 50-day, as it builds just the normal base, not necessarily a sell, right? What we want to really pay attention to in kind of that is that it does find some support, right? Maybe it broke through the 50-day, but it finds support at the 200-day, right? Or what was the volume like when it pulled back, right? Because a nice base will have nice low volume, very normal behavior. Every stock has a pullback, right? Even the biggest winners out there. And we just want to see that has low volume, right? Just build a nice base and then set up again and get high volume as it breaks out. And at that point, it's likely back above the 50-day and 21-day. Okay, so finally, our key takeaways. So custom moving averages give us better timing and clarity on entries and exits, right? It's just another tool that we can use. So we're not just looking at the price bars, but also just getting more information for our analysis. Of course, MarketSurge makes it pretty easy, right? To set these up, right? Just using that wrench icon, picking which time frames I want to use. I could just match the weekly chart to the daily chart, no problem. And then we want to combine the moving averages with our other signals as well, right? Say it's like with volume if a stock bounces off of a moving average. All right, so that brings us to the end of this webinar. If you have any questions, you can email us at marketsurge@investors.com. Again, my name's Jacob. I'm always happy to talk to people if there's any follow-ups, anything like that. I always enjoy talking to you all. You can give us a phone call, 1-800-831-2525. And then our phone line is open from 8:30 a.m. Eastern Time to 8 p.m. Eastern Time. All right. Great. Well, thank you so much, everybody. I really appreciate your time and attention. I hope you have a wonderful day. Take care.